The topic for today is, do sophisticated algorithm techniques work in India? Hi, and welcome to Smart Values podcast. If you want to know more about us, visit lambronanalysts.com. And if you would like to invest with us, please do visit smartvalues.co.in. This podcast is for educational purposes only and should not be relied on for investment decisions. I'm your host, Mamta, and we will be speaking to Mr. Soumitra Sengupta, CIO, Lambron Analysts. Good morning, Soumitra.
Hi, Mamta.
Soumitra, as the topic today, I think our investors would like to know what are algorithms and how can they be used to invest in the stock markets, please?
Well, Mamta, in its simplest definition, algorithms are a set of rules. Okay, nothing more elaborate than that. And they are designed and developed to achieve certain set of objectives, right? In the context of the stock market, algorithms use a set of rules to buy, sell, and hold on to investments. The rules can use various parameters like market timing, price, volume, and other forms of mathematical or statistical models. At Smart Values, we use statistical momentum models to identify trades. Algorithms are able to identify profitable opportunities in a more systematic manner than humans. And that is the advantage of using algorithms. Mamta?
Okay. So the approach is rule-based. Then do the rules change as the market environment changes?
Well, Mamta, it's true that the market environment does change, but some of the underlying rules or patterns continue to persist. I have talked about this in some of the other videos. The market moves in trends and there is a persistence of these trends. The trends per se remain, only the specific stocks that are in trend change. The rules that we deploy at Smart Values are good at identifying and staying with long-term trends. And we believe that these trends exist in different market conditions. Mamta?
Okay. How are algorithms developed and what is the assurance that they work?
Well, developing algorithms, Mamta, is an empirical process. What needs to be done is to identify the elements and determine the outcome, and then work through a set of rules that can be used to manipulate the elements towards an outcome. For example, in the case of trading rules, the elements can comprise of stock price, volumes, fundamental information about the company, such as earnings, sales, or technical information, which are essentially derivatives of the price, such as relative indicators, moving averages, RSI, ROC, and so on. The outcome would be profitable trades, right? Developing the algorithm entails combining the elements into rules that would lead to the desired outcome, which is to engage in profitable trades. Developing successful algorithms is a backbreaking process, as in most cases, rules do not work consistently and profitably over a long period of time. But once in a while, you do find an algorithm that works. The key issue towards ensuring the robustness and sustainability of algorithms is to backtest it over different market conditions. It is also important to ensure that you do not backfit the data. The rules should be loosely fitted to the data. At Smart Values, we use price data and momentum and trend following rules to develop our algo over a 10 to 15 year period. That is the period through which we do the backtesting.
Okay. There are many instances of strategies that work well on paper, but then burned out under live market conditions. So why do you think that happens?
Even they burn out under live market conditions, right? They work on paper and they don't work on the real market in real time.
Yes.
Well, There are a lot of do's and don'ts about developing algorithms. And one of the temptations, and as I said, I mean, algorithms are developed through a backtesting process where you take data and you test it on the data. That's called the in-sample data. And then you test it on other data, which is called the out-sample data. But one of the temptations while backtesting algorithms is to fit the data too closely to the rules. The result that it produces is very impressive backtested results. But since the rules are fitted, they usually do not replicate the testing results in live market conditions. The algorithms should not be valid only for the data period that is being tested. It should also work in live market conditions. Rules that are too closely fitted to the test data, the in-sample data, will not work on other data and in particular live market data. And that is the nub of the issue.
Okay. Uh, we've heard algorithms and black boxes, have had for a long time negative connotation, primarily because of their opaqueness. How can investors have confidence in such techniques then?
Well, I mean, like most things, I think the best way to do this is to see how long the algorithm has been in the market. Longevity is the best test of robustness. If a system or an algo has been in the market and has successfully managed money over a considerable period of time and across various market cycles, then the chances of that algorithm being robust is considerably higher. Investors have to look at the track record to understand the validity of the approach of the algorithm. The ones that have worked in the past and across many market cycles would have a greater chance of working in the future.
Okay. How quickly would you be able to determine if a particular algo has stopped working?
Well, the best way to do this is to keep comparing the performance, the live performance of the algorithm with its historical track record. There are certain metrics that are worth monitoring, such as maximum drawdown, the win-loss ratio, to see if the algo is deviating from its historical norms. If one decides on the metrics before using the algo, which is sort of analogous to instituting stops in case of a trade before you put the trade on, one can restrict the use of algos and stop using the algos or cut down the use of algos before too much damage is done.
So the algorithms which are used by the smart values, are they predictive in nature?
Well, we believe that one of the reasons for the robustness of the algorithms used by smart values is that they are non-predictive in nature. Making predictions is fraught with inaccuracies, and most predictions, even in the short to medium term, tend to be very error prone. We acknowledge our limitations and our inability to consistently make accurate predictions, and so we do not try. Instead, what we do is we follow the market. We use a set of trend following rules to navigate the market. In a way, you can say that we let the market be the manager and we follow it. The market usually gives an indication of where it wants to go. And this is a very reliable indicator because by definition, the market cannot be wrong by itself. So if you can read it well and follow the market, that tends to be a fairly robust approach to investing.
If they are not predictive, then how would they be able to generate superior returns?
Well, Mamta, there are three stages to the investment process. You have to buy, you have to hold, and you have to sell. But an inordinate amount of time and effort is given to the process of selecting and buying. But there is more to stock investing than just stock selection and buying. In our opinion, the amount of time you hold a stock and when you exit is as important and maybe more important than your entry. Using the smart values algorithms not only guides you on the stock selection, but also on how long to hold and when to exit. Overall, as a result, the smart values algo gives an indication on all three aspects of the trade. This helps in generating superior returns.
What are some of the other advantages of algorithmic trading?
Well, there are many advantages to algorithmic trading, and these are being recognized more and more. Um, okay, I can name a host of such advantages. Speed. Algorithms can execute trades at high speed because it's a machine that is executing the trades. Algorithms also tend to be highly accurate because it does not require human intervention to make buying and selling decisions. So they have a much higher accuracy rate and are free of human errors. For example, it will not misenter the quantity of units meant to be traded, and what are generally called fat finger problems in trading. Um, Using algorithms also frees you up from emotional interventions. As a trader or an investor using traditional online trading strategies, no matter what the strategy you use, everything can fall apart if your emotions get involved. Our emotions can derail the trading strategy and disrupt the discipline, resulting in unfavorable outcomes. However, algorithmic trading solves this major problem as a computer program is devoid of emotions. If the predefined conditions are met, the computer program will generate the trade. In this case, second thoughts cannot prevent the trader from performing or refraining from performing actions that they will later regret. So it also keeps overtrading and undertrading under control. Algorithmic trading also ensures decreased costs in the long run. Once the algorithm is set up, then the cost of maintaining it is relatively low. You don't have to spend money hiring analysts and research people and do a whole lot of data gathering, company interviewing, and so on. And the last, and I suppose one of the most important advantages of algo trading is diversification. Since algos can scan multiple sources, multiple charts, and multiple companies, it can be programmed to execute multiple trends. So it can identify many more opportunities than you would be able to do in a manual setup. Thank you, Mamta.
Wow, that insight was really extremely interesting. And thank you so much. Thank you so much, Soumitra.
You're welcome.